Welcome back. For the first time in this cycle, a major Wall Street bank just cut its XRP price target nearly in half. And on the same page of the same report, they raised it. The 2026 number went down 49%. The 2028 number went up. Same analyst. Same day. The crypto internet saw the cut and panicked. Almost nobody read the second half. That second half is where the smart money tells you where this is actually going. So let's break it all down. The bank is Standard Chartered. The analyst is Jeff Kendrick, one of the loudest institutional bulls on XRP for 2 years running. Yesterday, he slashed his 2026 target from $5.50 to $2.80. Then on the next page, he raised his 2028 target to $12.60. Two messages in one document. Message 1, the near term is worse than modeled. Message 2, the destination is higher than modeled. That is not a downgrade. That is a compression. The rally is delayed, not canceled. And the reason Kendrick gave on the record is the thing every holder has felt in their gut for 6 months. Tariffs? Macro? The force that has overridden every piece of good news this asset has received this year. Theory is nice. Data is better. Let's look. 2 stories are running at the same time. Miss one and you misread the whole picture. Story 1. The 6-spot XRP exchange-traded funds are bleeding. At their January peak, they held $1,240 million in assets under management. Today, $947 million, roughly $300 million gone in 10 weeks. March alone posted $31 million in net outflows, the first losing month since launch. The product built to pull institutional capital in is currently pushing it out. That is the fuel leak Kendrick was pricing when he cut the 2026 number. Story 2. Last month, Fidelity, one of the 3 largest asset managers on the planet, added XRP to its digital asset index. The index feeds their advisory network. That network manages $4.9 trillion. $4.9 trillion! While the existing ETFs lost $300 million, a $5 trillion advisor just opened a new pipe. It hasn't started flowing. Advisors take months to move allocations. But the pipe was not open 90 days ago. It is now. And here is the survey data that jumped out at me. FX Empire polled global fund managers this week on 12-month XRP allocation plans. In the fourth quarter of last year, 18% said they intended to add exposure. This week, 25%. 7 points higher in 3 months. 1 in 4 global fund managers now says on the record they plan to buy. That number does not climb when conviction is dying. It climbs when conviction is building, but buyers are waiting for a trigger. This is the Standard Chartered paradox in one line. Conviction is present. Pipes are opening, survey numbers are rising, but current ETFs are bleeding and the price is grinding. Capital is allocated in theory and not deployed in practice. It is waiting on one specific event. Now look at what whales have been doing while retail sold the ETFs. In a 48-hour window in early March, the largest wallets added 1.3 billion XRPs billion. On March 10th, $738 million worth of XRP moved off exchanges into cold storage. Cold storage is not coming back to sell soon. Retail is exiting through the front door. Institutions are entering through the back. This is the part of every video where I check myself. Because confirmation bias kills portfolios. Whale wallets can hold for years or distribute into a rally. On-chain data alone cannot separate the two. What I can say is this: in previous cycles, heavy cold storage accumulation plus falling exchange reserves plus new institutional product launches has preceded major moves. Not guaranteed. Preceded. The setup matches. Whether the outcome matches is what the next 60 days answer. Quick recap. Wall Street cut the short-term target and raised the long-term one. ETFs are bleeding at the top while Fidelity opened a new pipe underneath. Fund manager intent is at a multi-quarter high. Whales are accumulating faster than retail is draining. Now let's talk about the force pressing all of it down. Everything I just told you, none of it matters. Not yet. And here's why. Let's zoom out. There's a reason these positives haven't moved the price. Tomorrow, April 9th, the administration unveils the next round of tariffs. That is what Kendrick was reacting to, not an XRP problem. A macro problem. Every tariff headline this year has tightened the correlation between XRP and the NASDAQ, bid the dollar, and compressed every digital asset. When the stock market sneezes on tariffs, XRP gets the flu. Then the Federal Reserve meets on April 28th and 29th. 20 days from today, rates held. Inflation sticky above target because energy is elevated. Energy is elevated because the Strait of Hormuz, the most important oil shipping lane on the planet, is under intermittent disruption. Tankers slow, oil climbs, inflation stays hot, the Fed stays on hold, and capital stays parked in Treasury bills paying 4.5%. That is the chain. Tariffs push stocks down, oil pushes inflation up. Rates stay high, liquidity stays out of risk assets, and XRP, as risk-on as it gets, starves with everything else. Here is the contrast. Ripple just got a KBRA investment-grade rating on its prime brokerage arm. That unlocks pension funds and insurance companies' entire categories of buyer that were legally off-limits before. Ripple Treasury now sits inside payment infrastructure processing $13 trillion a year. The XRPL just crossed 8.19 million addresses. Fund managers are telling surveys they want in. All of this is real, and yet XRP is trading at $1.32. Fundamentals set the destination. Macro sets the timing. That single sentence is the whole year. Kendrick did not cut his target because XRP is broken. He cut it because the macro is taking longer to unlock than his model assumed. The destination did not change. That is why the 2028 number went up, not down. Only the arrival time changed. The train is still going to the same station. It is stuck behind a freight train called tariffs. Now let me pull up what the blockchain actually recorded this week. Daily transactions on the XRP ledger average over 2 million, higher than Ethereum on most days. The Ripple Treasury integration with Swift-compatible rails lets corporate chief financial officers move fiat and XRP through one dashboard. The dual settlement structure gives them a choice: Swift rails or XRP and the ledger. The second route is seconds instead of days, pennies instead of dollars in fees. The open question is whether corporate treasurers actually choose the faster option once they have it. And here's the uncomfortable truth the hype channels skip over. Most institutions on Ripple's infrastructure right now are not settling in XRP. They settle in RLUSD, Ripple's own stablecoin, and in fiat. On-demand liquidity, the one product that creates direct XRP buying pressure, runs in a handful of corridors. Ripple is now a $50 billion company. $4 billion in acquisitions in 15 months. Prime brokerage with $5 billion in cash and $40 billion XRP on its books. But most of the flow those deals unlocked moves through rails that never touch the token. That is the second reason Kendrick cut the 2026 number. Adoption of the company is running years ahead of adoption of the coin. The bet you make holding XRP today is that the gap closes. The single event that forces the gap to close is the Clarity Act. Picture the resistance above us as three doors stacked over the price. Door 1, $1.37. Door 2, $1.45. Door 3, $1.48. Behind each door, a crowd of sellers waiting to break even from a previous top. Door 1 is thin, moderate volume breaks it. Door 2 needs a real catalyst. Door 3 needs an institutional unlock. The conditions to break all three in the same month come down to three things. 1. The April 9th tariff reveal lands softer than priced. 2. The Clarity Act clears the Senate Banking Committee markup before the end of April. 3. The Fed signals at its April 29th meeting that rate cuts are still on the table. 2 of 3 takes out the first two doors. All 3 takes out the last one. None of 3 breaks the support at $1.28. The next floor below that is $1.15. 3 events in 3 weeks will decide whether XRP finishes April at $1.60 or at $1.15. Enough analysis, here's exactly what to look for. Signal 1. The tariff reveal on April 9th. Tomorrow, watch the first 3 hours of correlation between XRP and NASDAQ futures. Lockstep means the macro trade is still in control and the holding period just got longer. Divergence, XRP holding while equities dip, is the first technical sign that the on-chain accumulation is starting to deploy. Signal 2, the Clarity Act. Senate Banking Committee markup. Window is the second half of April. Senator Bernie Moreno went on record. If the bill does not reach the Senate floor by May, it is dead until after the midterms. A clean markup plus committee passage unlocks between $4 and $8 billion in projected XRP ETF inflows within weeks. That is the fuel for $1.60. A delay or a stall and $1.28 gets tested and probably broken. Signal 3. The price itself. Watch $1.28 on the downside. 3 holds in 2 weeks. A fourth hold starts to look like a base. A clean break below, more than a 2% drop on daily volume above $2 billion, is your signal to reduce exposure. On the upside, $1.37. A daily close above breaks door 1. A weekly close above $1.45 takes out door 2. Those 2 breaks in sequence are what convert this grind into a trend change. Signal 4. The Fed meeting on April 28th and 29th. Watch the dot plot and the inflation language. 2 cuts kept on the table for the second half means risk assets get permission to rally. Cuts removed entirely means another leg down across crypto. Bull case in 1 sentence. Softer tariffs, Clarity clears committee, Fed stays dovish. XRP breaks 137, tests 145 within 2 weeks, and Kendrick revises his 2026 number back up before the end of May. His own near-term corridor under those conditions is 165 to 180, bear case. Harder tariffs, Clarity stalls, oil above 100, 128 breaks. The market accepts the quarter is lost, price drifts to 115. Below 115, there is no meaningful support until just under $1. You don't need to guess. You just need to watch these signals. So let me bring this all together. Standard Chartered cut the short-term target by half and raised the long-term target in the same report. That is a time shift, not a loss of faith. Fundamentals are the strongest they have ever been. Infrastructure, partnerships, institutional access, whale accumulation. Macro is the weakest it has been in months. Tariffs, Middle East, Fed on hold, oil elevated. The gap between those 2 realities is the entire trade. If macro cracks open even slightly in the next 3 weeks, the fundamentals get unleashed. If it does not, we grind sideways to lower through April and regroup in May. I'll be covering every development, the April 9th tariff reveal, the Clarity Act markup, the Fed decision every day on this channel. Tomorrow, the tariff announcement drops. I'll have the numbers. I'll have the breakdown. I'll show you exactly how XRP reacted in the first 3 hours against the NASDAQ and the dollar. Don't miss it. The next 3 weeks will answer the question that defines XRP's entire second quarter. This content is for informational and educational purposes only. It is not financial advice. Always do your own research before making any investment decisions. Until next time, stay sharp, stay informed.